Welcome to The Explainer. So, today we're tackling a pretty essential crossroads for anyone who's investing in the Indian stock market's top 50 companies. We're looking at Nifty BeES versus Nifty index funds. Let's just dive right in.
If you've ever felt totally stuck at this exact crossroads, just staring at these two options and wondering which one is actually better for your money, trust me, you're definitely not alone. It is such a common point of confusion. You've got your capital, you know for sure you want to invest it in the top 50 companies, but picking the actual vehicle, it feels like a ridiculously complex decision. Well, we're going to clear that whole thing up today.
Here's our quick roadmap for today. We'll start with the Nifty 50 crossroads, then meet the contenders, weigh the pros and cons, look at the actual costs and tax reality, and finally make your choice.
All right, part one, the Nifty 50 crossroads, where we find our common ground.
So here is the absolute foundational concept you need to grasp right out of the gate. Whether you go with Nifty BeES or an index fund, you aren't actually choosing different underlying assets. The destination is literally identical. Both of these options invest in exactly the same top 50 companies in India. Just to put some familiar faces to that concept, both of these give you direct, heavyweight exposure to massive companies like Reliance, HDFC Bank, Infosys, TCS, ICICI Bank, you name it, the entire Nifty 50 lineup. Basically, you're getting a slice of the exact same corporate pie, completely regardless of which route you actually take.
Moving on to part two, let's meet the contenders and really define these options.
Let's kick things off with Nifty BeES. So this is an exchange-traded fund, or an ETF. It tracks the Nifty 50, obviously, but here's the kicker. It trades on the stock exchange exactly like a normal share of a company. The price fluctuates all throughout the day, meaning it behaves just like any other stock sitting there in your portfolio. Now, the core difference here isn't what they invest in, but how you actually acquire them. While Nifty BeES is trading actively on the exchange, a Nifty index fund is essentially a mutual fund. You're purchasing it directly through an SIP, a systematic investment plan, or maybe via a lump sum. So structurally, it's just a completely different purchasing mechanism.
Okay, let's get into part three, weighing the pros and cons.
Let's look at the pros of Nifty BeES first. Number one, they usually feature a slightly lower expense ratio, and that translates directly into lower annual costs for you. Number two is flexibility. You can buy and sell anytime during active market hours, just like a stock. And number three, transparency. Because it's trading actively, you can see those live prices ticking away throughout the entire trading day. You know exactly what price you're getting at that very second. But naturally, there are some cons. First off, you have to have a demat and trading account. Now, you probably already have one, but for some folks, managing that just adds an annoying layer of friction. Second, because they trade on the open market, ETF prices can actually deviate. They might trade slightly above or below their true underlying value just based on market supply and demand. And third, while SIP investing is absolutely possible with an ETF, it honestly just isn't as seamless or automatic as setting up a mutual fund SIP. Now, right before we look at the index fund side of things, we need to define a really crucial term: end-of-day NAV, or net asset value. This is the value that's calculated at the very end of the trading day. So unlike ETFs where prices are just jumping around all day long, mutual fund transaction prices are determined entirely by this single end-of-day number. Keeping that NAV concept in mind, let's switch gears and look at the pros of Nifty index funds. Number one, incredible simplicity. They are extremely beginner-friendly. Setting up a monthly SIP takes literally just a few clicks. It is the ultimate invest and forget setup. And because you're dealing directly with a fund house based on that NAV, you absolutely do not need to worry about trading volumes or market liquidity. The fund just handles the whole shebang for you. However, looking at the cons for index funds, there's definitely a flip side. First, the expense ratios are usually going to be a little bit higher than ETFs. Second, like we just talked about, you don't get real-time market pricing. Your transactions happen at that end-of-day NAV. And third, you can't actively trade them during market hours. You basically just put your order in, and then you have to wait for the trading day to actually close. All right, part four, costs and the tax reality. Let's look at the actual math behind all this.
Let's make this super practical with a 1 lakh rupee example. So if Nifty BeES has an expense ratio of, say, 0.05%, your annual cost is a mere 50 rupees. An index fund sitting at 0.20% is going to cost you roughly 200 rupees. So the mathematical difference, we're talking about only 150 rupees per year on a 1 lakh investment.
Now, stretch that out over 5 entire years, and the grand total cost difference is roughly 750 rupees. Honestly, you kind of have to ask yourself, is stressing over a 750 rupee difference, which is literally less than the cost of a nice dinner out over half a decade, is that really worth losing sleep over?
And what about taxes? Well, I've got great news for you. For tax purposes, both of these are treated as equity investments. The rules are exactly the same. If you sell within 1 year, your profit is a short-term capital gain taxed under prevailing equity rules. Hold it for more than a year, it's a long-term capital gain taxed under long-term rules. So from a pure taxation perspective, there is virtually zero difference between the two. They're on the exact same playing field. Which brings us to part 5, making your choice. Which one of these is actually for you? So, what's the verdict? Well, it really just comes down to your personal setup. If you're the type who wants to actively squeeze out the absolutely lowest possible cost, and you really don't mind managing your demat account, then Nifty BeES is excellent for you. But if you prefer a completely automated, hands-off approach where you aren't constantly tempted to check live market prices, then an index fund is definitely the better route. But listen, here is the real truth of the matter. Because both of these instruments invest in the exact same companies, your actual financial success is going to depend far less on the specific vehicle you choose, and way more on your own consistency over the next 10, 15, or even 20 years. Your discipline, your ability to just stay invested, that matters so much more than optimizing for tiny little fractions of a percent. As the saying goes, the best investment is the one you can stick with for the long term. You really just need to choose the method that fits your own daily habits. So I'll leave you with this thought. Are you going to optimize for every last fraction of a percent, or are you going to optimize for your own peace of mind? The market heavily rewards patience, so which of these two vehicles is actually going to help you stay the course? Thanks so much for joining me on this explainer, and I'll catch you next time.